Okay, good afternoon. Stewart Fulton, Neutral ATM. This is our second, well, really, technically our third video. The first one was just instructional on our ATM machines, but um, today we're going to talk about yesterday and today's blogs. And today's blog was short and sweet, so we'll focus more on yesterday's blog. The big news today, obviously, Bitmex. It was a long time coming. Bitmex was an exchange that I had heard for months not to use. There was issues going on. I wasn't, up to date. I use Kraken, and I'm happy with that. But like Bitmex is going down. There's charges being filed against the owners, and Mr. Hayes being the main one. But like it's caused Bitcoin to drop from almost 10.9 down to 10.450, and right now it's at 10.574. So it was at 10.450 at noon, around noon today, and it's 1 o'clock Central Time. So a little after 1 o'clock, and so it's coming back. I mean, I don't think that this Bitmex crash is going to be a long-term problem for Bitcoin. It's I would expect it will get back to the 10.8 range where it was 10.9 range, by Friday, Saturday. Hopefully, at least at the latest by Monday. We'll see. But my goal in these videos is to talk global macro and the long-term view and investing in general, investing and even entrepreneurship, where to start businesses and things like that. Because I'm not a stockbroker. I don't have that background. I'm not a technical analysis guy. I'm an entrepreneur. And so that's the background that I want to focus on. As far as the blog from yesterday, we already talked about it dropping off because of Bitmex even further than where we had climbed to at the end of September, which was actually 10,789 to close out the month of September. So we had, as you can see on my cursor here, a nice long tail. The low in September was 9,800, so it was almost $1,000 on that tail of the candle for the monthly candle for September. So that gives us some momentum going into October. Obviously, the Bitmex takes some of that away, but I hope and think that it will be fairly short-lived. And I do believe October is going to be a strong month. Why do I say that? Well, if you look on this chart, the 2019 high was 14,000 and change, and the body of the candles was almost exactly where we are right now. My eyesight isn't so good. Sorry about that. Yeah, so we've got we're actually the body of the September candle is above the body of the candle in July of last year when we hit the 14,000. It was just a wick up and down that hit the 14. So we weren't there long, and we're now in day 67 over $10,000. So Bitcoin is this cycle, this bull market cycle we're in right now. It's going to be slower than it was 2016 and 17, and slower than 12 and 13 as well. So we have to be more patient, and obviously it's an election year. Of course, 16 was too, and this cycle seems worse. But I'm not here to talk about politics or any of that. Just investing in Bitcoin and the uncorrelated investing in entrepreneurship. So I'll try to get right to the point. The October momentum that we're coming into off of September, I think it's still there. We'll know that by Monday. What kind of an impact Bitmex had on the BTC price overall, and if it's really going to slow down the month of October. and the momentum we have from September. But I think the answer to that will be no. I don't believe that. I really, really don't believe that. So we've got to move on. And we can't let it slow us down and think too much about it. We just watch the price and see where we are by Monday. Now, as far as the hash rate is concerned, it's at all-time highs. It's been trending that way for quite some time. There's plenty of charts about the hash rate from Glassnode that are on Twitter, and we're going to look at some other things, but the hash rate is at an all-time high, and that is absolutely a positive for where how healthy Bitcoin is. Another one is this was made yesterday, so it was 66 days. Now we're 67 days over 10,000, and even with the Bitmex announcement at 10 this morning or 9 this morning, we only dropped to 10,450, so we still have not had any closes below 10,000. We wicked below it in the early September, but didn't stay below it by the end of the day. So we've maintained 67 days over 10,000. Grayscale bought 9,202 Bitcoins over the last week. Well, Bitcoin can only produce 6,300 Bitcoin per week, 900 per day, 7 days in a week, 6,300. So this is far over significantly over the supply. And the demand on the Grayscale, their ETF is very high. Institutional investors and retail investors, that demand is above the supply. And I also saw this on Twitter. It was speculation. I don't know that it really counts for much, but I'll mention it briefly. If our coin's going to be lost because of the Bitmex going away, or are those all going to be recovered? I don't know one way or the other. I never used Bitmex. I don't really know of anyone that I've dealt with that does, but that will only make Bitcoin more scarce if that does happen. I hope it doesn't. I hope no one loses a single Bitcoin over that, but it would make Bitcoin more scarce. Now, what we want to talk about a little bit more for this blog from yesterday is the economy. Now, I'm going to go to this graph on the Fed graph from the St. Louis Fed. It's debt to GDP, so let's open that up. Okay, put my glasses on again. Now, 107 and change for the first quarter. But the second quarter I know ended at 110%, and the third quarter should be a good bit higher than that. So we're closing in on 120% debt to GDP by the end of the third quarter, which obviously was last night, and we're not going to get those numbers for weeks. But nevertheless, it's trending in that direction. We should end the third quarter, when we get the numbers from on the Fed graph, it should be close to 120% debt to GDP. And it's been trending, obviously, parabolic in the last few months. It was trending up since the 2008 recession. So what I want to show you is all the way back to 2008. The gray is that recession in 2008. The gray back here is the 2001 recession. But that was a debt crisis in 2008. And the U.S. economy has been increasing its debt to GDP ratio and M1 money supply ever since 2008. Now I'm going to get out of this graph and we're going to go to the next one. We'll try to move quickly here. Okay. All right. Now on this graph, get the picture out of the way. On this graph, clear it out. We've got velocity of money, M1. M2 is money supply, M1 is velocity of money. Now for velocity of money, that's just, the velocity that money is being spent going from business to business, person to person. So these numbers here, second quarter, 3.89, 3.89 second quarter. And it's 10.6 here in 2008. If you see my cursor, I know it's 10.6. So that ratio of velocity of money dropped from 10.6 to what was it, 3.89? Yeah, 3.89. So 66% drop in 12 years. So what we see since the 2008, 2009 recession, the Great Recession, is money supply parabolic, trending up, velocity of money trending down just as steep, and now as you can see on this chart, follow the cursor, I mean it's parabolic straight down, anti-parabolic. Huh? So that affects demand, right? I mean the demand for buying goods and services is drastically increased, and there's some industries that are worse off than others, like travel and entertainment, but in general, demand is way off. A 66.67% drop in about 12 and a half years. And debt to GDP ratio is way up in that same period of time. And we saw that in the debt to GDP graph. I mean, I think I'm going to go back to the debt to GDP for a second. I want to look this up real quick. 2008. Yeah, we'll look here. Looks like we were in the 60s, whereas right now we're probably approaching 120%. We were like 65% debt to GDP in 2008, and then it just went parabolic. By 2009, it was 85. It breached 100 in 2012 or 11, probably 12. So and it hung in there most of the first term for Trump, but obviously since the coronavirus, it's just parabolic. And I do believe that before the election, we're going to see a stimulus, and it'll probably be, like I said in Tuesday's video, it'll probably be in the 2 trillion range, 1.8, 2.2, 2 trillion even, in that range. Stephen Mnuchin is trying to keep it down, but I don't see how he's going to be able to tamp it down. Trump, to get his support leading into the election, is going to demand that this goes through, this stimulus goes through. It's going to have to. So I think for political reasons, it's going to happen. But unfortunately for the economy, it's just going to exacerbate some of these problems. Now, a misconception that I hear a lot, and we're going to have, I can promise you, we will have a future blog about this where we focus on this for the whole blog and video. But it's a common misconception that QE and all the money printing and the loose fiscal policy with printing and running hot on inflation. And I mean, it's been widely reported that Jerome Powell announced they want at least 2 to 3% as their target for inflation, CPI inflation. Now we know that for those of you who have read my blogs in the past, a month or so ago, I put a blog out that had the Chapwood Index on it. It's 9% for Texas, where I am. It's like 13% for California and New York and the Northeast. But in the Midwest and the South, it's high single digits, and that was last year. The Chapwood Index for 2020 will come out maybe by the end of the year. I'll have to look that up, and I'll do another blog and video on that. But inflation, real inflation, is much higher than the CPI. But the point is, Jerome Powell set his targets at 2 to 3%, and is he going to really be able to reach those targets if quantitative easing is in fact deflationary? Well, I would submit to you that it is deflationary, because when the Fed buys treasuries, whether they be A-rated or B-rated or junk bonds, they end up in the TGA, Treasury General Account, and that money goes to the bank reserves when the treasuries are purchased, and then the banks can loan against those bank reserves, dollar for dollar. They can loan against those bank reserves, and generally a lot of those loans are going to Fortune 500 companies to buy back stocks, to to zombify their company, to buy back their stock, pump the stock price, grow the equity markets, Nasdaq, SPX, Dow Jones Industrial, but and it helps the executives in those Fortune 500 companies that are in these indices, but it does not help Main Street. It does not help the middle class, and really, what my end goal for my videos, the blogs, and in the future at some point I'll do a newsletter too. But my end goal is to get people to understand in general, in the public, that Bitcoin or Ethereum, gold, silver, real estate, fine art, digital art are all uncorrelated investments, and they will do better than stock investments in this new environment until we deleverage. And how long and how are we going to deleverage? Well, I mean, deleveraging can happen in many different ways. I think we're going to have low interest rates, and we're going to have very high money supply and very high debt to GDP, and extremely low. And someday, next year or the year after, someday we're going to see negative interest rates, and that may be what will really spark off a steeper decline, a steeper devaluation or deleveraging of asset markets, equities, stock market specifically. But until we get to negative rates, I don't see a strong push for devaluating stocks in the short term. It's more of a long term, longer term, and it'll probably be a slow decline, not a speedy deleveraging event all at one time. But if stagflation is the future, study Japan, study what happened there the last 20 years, because they've been going through it that long. I mean, stagflation, it's just a slow motion recession is what it is, where the Fed steps in and doesn't allow the recession to happen quickly and to recover quickly, so it just drags on and drags on and drags on and on. And how do you survive that? Well, I mean, I would submit to you that uncorrelated assets that aren't correlated to fiat currency, paper money, aren't correlated to stocks, which are directly influenced by the Fed. Obviously, the value of fiat currency is directly influenced by the Fed. And it's not just U.S., it's global. So the euro is in just as bad a shape as the dollar. But like these assets, Bitcoin, Ethereum, gold, silver, real estate, fine art, digital art, are all uncorrelated. And unless we have just a major deleveraging event, which would seriously hurt real estate and probably a lot of these other ones too, these assets are going, due to their scarcity, primarily due to their scarcity, these assets are going to grow much faster than stock investments, bond, cash-based investments. They're just going to grow much faster. So my goal is just to open the door, open the window to these possibilities and talk about them. So I hope that spurs more interest. Smash up the like button. Send me questions in the areas below for comments and questions, and we can certainly answer those in future blogs. Thank you. Have a great day.